Hello, beautiful people, and welcome to another brand new edition of the ITU Forex class. In this week's class, we're actually going to be talking about technical analysis for beginners. Okay, so if you're brand new to trading, I'm pretty sure you must have heard about technical analysis used as a method for determining when is the optimal time to get into the market with a trading position. As you probably know, for you to be able to make money in this trading industry, you need to do one of two things, okay? In simple terms, you need to buy when the asset you want to trade is cheap so that when it gets expensive, you can sell it back to the market and bank your profits. Or the other method is for you to actually sell the asset when it's expensive so that when it decreases in value, you can cover your short, cover your trading position which you actually sold so that you can bank your profits. This is, in basic terms, one of the two ways you can actually make money from trading. Now, what does this have to do with technical analysis? Well, in simple terms, technical analysis is just a fancy way of saying using science to actually adapt to an environment where what happened in the past is likely going to happen in the future. Okay, so technical analysis in and of itself, it's built upon the logic or the idea that history tends to repeat itself. So if XYZ happened in the past, there's a very high chance that it could. There's no certainty here because you need to understand this. A lot of traders, in fact, not a lot of traders, even myself, when I got into trading in the first early stages of my trading career, I actually thought that using technical analysis or learning a lot of trading techniques or analysis styles and everything, the more I learn, the more I'm going to be able to predict what price is going to do 100%. But that's not the case, because once you understand what technical analysis is, you know that it's not a crystal ball that tells you what is going to happen in the future with certainty. It's only giving you an edge that will give you kind of like a probability of one thing happening over the other. This does not mean that 100% of the time, when technical analysis tells you that there's a likelihood of something happening, that thing is going to happen 100% of the time. No. And this is where the whole trading thing, for it to work for you and make you profitable, for you to be able to make it a business which you can earn a full-time living, a full-time income with, you actually need to understand that because technical analysis just gives you a probability of one thing happening over another, you cannot afford to risk 100% of your trading capital on each and every trade you took. Because if you did that, you'd be out of business very, very fast. Okay, so going back to what we were talking about, technical analysis, the idea is that history tends to repeat itself. So let me show that to you in practical terms with what we are looking at on the chart. Okay, so if you remember from the class we did last week, we talked about how using a simple, very simple, basic moving average trading strategy, which which you use a crossover to determine when to buy or when to sell or when to close your open trading positions and reverse or switch your positions to the other side. Okay, now the idea is that you can see that this was in the past. The past, we had the black moving average cross below the red moving average, and when that happened, price actually moved down significantly. So if after seeing a crossover like this, you took the opportunity, took the initiative to take a short trading position on this pair, and you only close that short when the opposite of what happened here happens again, then you would have been in cool profits with this trading position. Okay, now the logic behind technical analysis is that since this is what happened in the past, okay, then there's a strong likelihood that when price crossed over, when the moving average, the slow one, crossed below the fast one in the past, price moved down, then there's a high chance that if that was to happen in the future, then price is also going to continue moving down. Now, pay attention to what I said. There's a likelihood. Does this mean that every single time you see the black moving average, which in this case is the fast moving average, 50 periods, so does this mean that every time the 50 period moving average crosses below the red 200 period moving average, that price is going to move to the downside? Of course, no. because there are times when there will be what do you call it, whipsaws in the market, or consolidation, or choppy price action. Okay, so when that happens, then price is going to, when the moving average crosses below price, then it's likely going to reverse again and move in the opposite direction. So in this case, if you took a trade here because the black moving average crossed below the red one, then you're likely going to suffer a loss from that trade. Now, does this mean that because there's a likelihood that this would happen, that we're never ever going to be taking trading positions? Of course, no. The way around this is for us to take trades with proper risk management, so that when the trades that work in our favor actually move in our favor, then we're going to make much more profits than the amount of money we're going to lose when the trades we were hoping to do one thing turn around and do the opposite. So that at the end of the day, even if we were to lose more trades than we win, the profits from our winning trades would be more than enough to cover for the losses from our losing trades. And that's, in essence, what trading is all about. So technical analysis is kind of giving you the idea that, okay, yes, when a signal occurs on your chart, or when a signal pops up on your chart, the price is likely to going to do one thing. But it's not 100% certain that price is going to do that thing. And that's why risk management is imminent. Because if we were to know 100% certainty, with 100% certainty, that price is going to do one thing, then there's absolutely no reason for us to use proper risk management. Because if you knew that price was going to move 10 pips or 100 pips, an hour from now, then it wouldn't make sense for you to limit the amount of money you're going to be risking on the trade, because you're just going to be limiting the profits you'd make from that trade. And that is why, because we're uncertain, and again, in trading, you don't need to know exactly what's going to happen in the future for you to be a profitable trader. And that's why the way around this is to use proper risk management. When we use proper risk management, risking very little and aiming to make more than, on average, more than what we make, okay, more than what we lose on losing trades, then eventually, even if we were to lose more trades than we won, we'll be profitable. Now, let me show you a quick example of this theory in action. Okay, so look at what happened here. Okay, again, remember, technical analysis, the whole idea behind technical analysis is that history repeats itself. So what price did in the past, there's a likelihood that when something occurs in the market again, price is likely going to repeat that thing. And the distinction I'm making here is that just because price is likely going to do that thing does not mean that it's going to do that thing with 100% certainty. So even though technical analysis is hinting and giving us an idea that this happened in the past and it's likely going to happen in the future, we actually couple it with proper risk management, so that for the times when it doesn't work, we're actually going to be protected. And for the times when it does work, we're going to make enough to, provide for ourselves in the process. Okay, so here's an example. We have a buy trading signal here. And why do I call this a buy trading signal? This is because this is if we're using this simple moving average trading strategy, where if the fast moving average, which in this case is the black one, when the fast moving average crosses above the red one, then we're going to take a long trade. And we're not going to close that long trade until the opposite happens. That the black moving average goes from being above the red moving average to crossing below it. That's when we're closing our trading position. Now, for this particular example, you can see that the crossover happened somewhere around here when price was somewhere around here. So if you are taking a long trading position here when the crossover was confirmed, and you held on to that trade until another crossover happened somewhere around here, then you'd have gotten into the market with the trade in and around here and gotten out somewhere around here. So you would have been able to bank some profits from this trading position. Now, pay close attention, because this is a long trading opportunity. You got into the market with a long trade because this moving average, the fast one, crossed above the red moving average, the slow one. Okay, now why am I saying you should pay attention? The reason is because look at another setup we have here. It's the same thing. Okay, the black moving average, which in this case is the slow moving average, moved away from, the black moving average crossed above the red moving average. So we have another long trading signal here. Okay. So for this particular trade setup, you can see that the moving average, the 50 period SMA, I think it should be an SMA on EM. It doesn't matter. It crossed above the red slow moving average. And when this happened, you can see that price actually moved way up. So if you had entered into the market when the crossover happened, which would be somewhere around here, okay, then you would have held on to this trade for hundreds, if not close to thousands of pips for this particular trading position. Now, why is this so important? The reason why this is important is because when we move forward in time just a little bit, you can see that we have a trade setup here where price moved, the black moving average crossed above the red one. Now, based on technical analysis, history tends to repeat itself. So if we're going by that and we're not thinking, using a probabilistic thinking approach to trading the markets, then we would assume that whenever this black moving average crosses above the red one, then price is going to go up because it went up significantly in the past. But you can see clearly in this example that this wasn't the case, because if you had taken the trade when the crossover happened somewhere around here, then you would have been out of the position when this opposite crossover happened somewhere around here. So you would have gotten in here and gotten out somewhere here. And this trade would have been a losing trade. And that's exactly the point I'm making here, because technical analysis is just giving you a pointer, an edge, an educated guess that one thing is likely going to happen over another. So in essence, when technical analysis shows you that, okay, whenever you see a moving average, the fast one cross below the slow one, forget about the period of the moving average. This is just an example, okay? Whenever it crosses, then price is likely going to move to the downside. But if this was going to happen 100% of the time with absolute certainty, then there will be no need for risk management, for proper risk management. Because if you knew that whenever this moving average, the fast one, crosses below the slow one, the price is definitely going to move down, then why would you risk 1% of your account when you can risk all of your account and make much more than that? And that's the lack of knowledge of the future for us, which is something you don't even need if you're trading, because you don't need to know what will happen to be able to make money. With proper risk management and an edge, you're good to go, okay? So if you knew that whenever this moving average crosses, it's just giving you an indication that price is likely going to move down, but it's not actually 100% confirmed that price is going to move down. So when the crossover happens, the likelihood, the probability that price is going to move down is higher than the probability that price is going to move up. And as a result of this, for us to be able to position ourselves in the market with a trading position which will favor us if what we are expecting price to do actually happens, then we're going to be getting into the market with proper risk management so that we can survive the times when we assume that price is going to do one thing and it doesn't. So in this case, when we have a crossover like this, we're going to use proper risk management to risk no more than 1% of our trading account's capital, or using a lot size to place the trade, which is very little, which is going to make sure that we're not going to blow our trading account on the trade. So in this case, when we enter into the market with the short trading position after the crossover occurs, then if price moves in our favor and goes down, that's exactly what we were expecting. And so we would have capitalized from that down move from the signal that we got earlier. But if after entering into the market with the trading position, and then price decides, you know what, I'm not going to move down again, I want to move up, then we're going to quickly cut our losses so that our losses will be very little in the grand scheme of things compared to our winning. That's the profits from our winning trades. Okay. So again, this was an example to drive home the point that technical analysis is not a magic pill. It's not some crystal ball, because a lot of traders who get into the trading industry when they start learning how to analyze the market, how to find when to buy, when to sell, low risk, high probability trading opportunities, most of them, when they get introduced to technical analysis, they actually think that the more they learn, SMC, ICT, whatever thing is reigning at that particular moment in time in the trading social media sphere, they think that the more they learn, the more jargons that they can speak with about trading, the more they are going to be profitable. But if you've been in this industry for some time, you'd actually know that the more people talk about the market, the more they assume to, the more they kind of try to exude that aura of knowing exactly what price is going to do, the less they make in profits. You could see a trader who barely knows what fundamental analysis means or barely understands what technical analysis means. But then because he is disciplined, because he has a good edge in the market, because he practices proper risk management, you could see that trader making much more money than somebody who is, like a professor in the trading industry, who has years and years and years of, theoretical knowledge and understanding all of this is what price should do and this is what price should do, but actually has zero discipline when he's placing a trade and trades with reckless risk management and all of that. Okay, so basically this is what technical analysis is all about. Technical analysis is just showing you that, or explaining to you that history repeats itself. But just because history repeats itself doesn't mean that every single time that something that happened in the past gives you a signal of likely happening again in the future. That doesn't mean that the current example that is showing you, the current recurrence of that particular thing, is exactly the same as the one that happened in the past. No, because this is random. The game is random, and every moment in the market is unique. So just because you see a crossover of price to the downside, yes, if in the past it happened and you got 1,000 pips from a trade, this could be the one that could happen, and then price decides, you know what, I'm not going down again. I want to move up. And so this is what makes risk management so important. Because if you're not trading with proper risk management and you just feel, it's technical analysis, history repeats itself, this, blah, 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 then you're going to be in for a surprise, because there are times when you're going to take trades assuming that, okay, price did this in the past 100 times or whatever, and now I'm expecting it to keep doing it again. And then it will surprise you and make you understand that, you know what, it's not going to do what you thought it would. Okay? Therefore, whenever you hear traders talking about technical analysis, just know that it is not some magic bullet or some, analysis technique that will give you insights into what's going to happen in the future with 100% certainty. It's all probabilities in trading. Technical analysis is simply showing you a signal, or explaining to you that a signal which you see, which tells you about something that happened in the past, whenever it occurs again, is just giving you a likelihood that what happened in the past is likely going to happen again. But that's not 100% certainty. And so when it shows you this signal on the charts, you need to be careful and protect your account, which is the number one rule for any professional trader. Anyways, you need to be very careful and protect your account using proper risk management, because when a signal of something that happened in the past based on technical analysis occurs again, it could work out favorably for you, or it could work out, in a way that you didn't expect it to, which is maybe unfavorable to you. And so if you are not trading with proper risk management, then that could easily wipe out years and years or months of, disciplined trading with proper risk management and the little profits you're able to accumulate. And that's why you don't want to do that. You don't want to take, 5 steps, 1 step forward and 2 steps backwards. Like, you've been trading for months or maybe a couple of years with proper risk management, doing everything. But then, because you got overconfident and, you got greedy or something got the better of you, you're now risking a huge chunk of the profits you've made on a single trade, which could easily go, against what you thought. That's just what technical analysis is. Most people who are getting into trading for the first time, they think that technical analysis is just some way of, the more you learn about analysis techniques, other blocks, SMC, ICT, this, that, all of those things, the more you know about them, the more you're not going to take losing trades at all. And that couldn't be further from the truth, because at the end of the day, you could do all of the analysis in this world, but you need to remember that it's real people interacting with the markets that actually cause movements in price action. So just because your technical analysis approach tells you that ABC is going to happen, someone out there, somewhere in the world could get into the market with a big trading position or get out of the market with a trading position, which could completely destabilize what you thought your edge, was in the market. So you need to understand this. No matter how good a trading setup looks, no matter how good a trading signal looks, there's always, always, always that probability that it's not going to work out favorably for you. Because if it was going to work out favorably for you, then there's no need. If you knew with 100% certainty that the trading signal that you're seeing now or the trading setup you're seeing on your charts is going to work out 100% the way you thought it's going to work out, then why would you need to do proper risk management? Why would you risk 1% when you could risk your entire trading account's capital, or even your entire trading account's capital with a loan from the bank and loan from your friends and everybody to go huge on that trade and then make everything, be the world's next richest person? But that's not how trading works. Even the Warren Buffetts, the George Soros, the Richard Dennises, the huge traders in the world. In fact, it will surprise you to know that one of the best traders, based on what we've learned in trading history, Richard Dennis and all of the turtle guys and whatever. In fact, when you analyze their trading performance, you'd find out that they lose more than 40% of the trades that they take. It's just that the winning trades they have, they tend to bring in most of the profits that they end up with, and then they just take small losses. And that's why you'd hear a lot of traders keep saying, cut your losses short, professionals that is, cut your losses short and let your profits run, because the logic is that you're not going to know with 100% certainty. No matter how good your trading strategy is, you're not going to know every single trade which is going to be a winning trade in advance. You can't. And that's why whenever you take a trade, you want to do proper risk management so that if the trade doesn't work out the way you thought it would, you're only going to be losing a small chunk of your account's capital. But if it does work out the way you expected, then you want to be capitalizing on the trade based on how the markets will favor your particular trading strategy at that point in time. Okay, so with that out of the way, this pretty much brings us to the end of this week's edition of the IT Forex class. And I really wanted to take my time to explain this to you because most beginners do not understand that this is the way trading works. They feel, when their mentor teaches them a trading strategy and he tells them that trading strategy has a 60% win rate or whatever, then if they take, for example, 10 trades, then they expect it to be exactly 6 winning trades and 4 losing trades because my mentor said it's, trading, the strategy has a 60% win rate. But that's not how trading works, because, again, at the end of the day, it's all probabilities. You could get hit by a losing streak, an extended losing streak before you get into, the trades that will bring you profits and all of that. Now, if when you were experiencing that losing streak, you lost it. What I mean by you lost it is you got, your emotions got the better of you. And so instead of risking 1% of your trading account's capital per trade, you ended up risking way more than that. And you ended up blowing your account. When the winning trades come, you're no longer in the game because you don't have the capital to trade and make back the losses that you had because you got emotional. And so you need to do proper risk management because you don't know when those losing streaks are going to come or when those winning streaks are going to come or anything like that. You just need to understand that trading is a probabilities game, and if you play the probabilities well and pray that eventually you are going to come out on top after taking a large number of trades. So another thing I would like you to focus on is that just because technical analysis says history repeats itself and the edge is in your favor because you're trading with a strategy that gives you an advantage over the market with proper risk management and all of that, you need to take a large number of trades before that edge is going to manifest itself. So you can't just take 1 or 2 trades or 10 trades and expect that your trading strategy is going to, give you all of the money in the world or whatever. You need to take a large number of trades, ideally anything from 30 trades to 100 trades. You need to take those trades because that is when your the power of your edge is going to play out in your favor most of the times and give you that opportunity to cash in with profits. Okay, so before we wrap up the class, I would like to quickly let you guys know about the ITU bots, okay, which are a segment of the services which we offer in the company, which are designed to help you earn while you're learning by getting automated trading expert advisors to trade on your behalf. So while you're learning how to trade with manual techniques and all of that, you could allocate some of your portfolio to automated trading so that they can the bots would look for low risk, high probability trading opportunities in your favor, capitalize on those opportunities by opening trades for you, and then managing the risk and doing all of the hard work for you, the heavy lifting for you. Okay, so if you're interested in that, please reach out to us on the socials and we'll be more than happy to assist you set everything step by step. Okay, this particular opportunity is even more in line with with people who would like to, get their hands dirty and start trading in the forex market, but maybe they don't have the time to, sit behind the chat or take a look for trade setups and all of that. So if you're interested in that, please reach out to us on the socials or drop a comment in the comment section and we'll be more than happy to assist you set everything up. Once again, before we wrap up the class, I would like to use this opportunity to thank each and every one of you for making time out of your busy schedules to come out to attend this class and learn one or two things to improve your trading performance. I look forward to seeing you guys in next week's edition of the IT Forex class. Have a wonderful rest of your trading week. Go out there and crush the market. Cheers, okay?